Hey guys, Stefan Livera here. Today I wanted to talk about crypto funds and what I think they're getting wrong. So we're seeing some of these funds come out now, and to put it simply, there's too many altcoins in these funds that are getting pumped. Why is that? It probably is because in their own minds, they feel like they need to justify the fees that they're charging. So in their minds, they're probably thinking, and when I say they, I mean the people who set up these funds and run these funds, they're probably thinking, oh, if I just made a fund and purely put it into Bitcoin, then my investors could just talk to me and say, well, hang on, what am I paying you guys for? I could just go and get Bitcoin myself and hold it myself with my own private keys, so on and so forth. Now, there are various reasons why the fund approach might actually be better for these people. So for example, the fund might be able to specialize more in correctly storing the keys and proper management and diligence around buying and selling of the coins, so on and so forth. But I think at a high level, you're seeing some of these funds who are basically trading in and amongst the different altcoins, and it's treating it almost like cargo cult finance. It's thinking that we should apply the same approach to crypto coins as we should with stocks and bonds, say. And that the way that you would diversify across the portfolio of stocks or diversify locations around the world, that this would be an appropriate approach also to apply with crypto coins, when cryptocurrency is not the same thing. Bitcoin as a currency, it's the only game in town, and I think that we're going to see people come to this understanding over time. So let's go into screen share, and I'll just show you a couple things. So the impact of fees over time is massive. You need to understand this. You go and do some of the research, but essentially here's a couple articles that show you this sort of thing. So as an example, comparing with zero management fee versus even just a 1% fee, which in many cases is cheaper than what the average person is paying. They might be paying what's called 2 and 20. So 2% management fee and 20% performance fee. That's like a typical sort of thing that you'll see. So the problem is it really impacts the way your asset will compound over time. So here's an example. So you can see here, even just after 10 years, the amount that you've sort of lost to your fees is 6%. But then what really happens over the long run, so in this example here with the 40 years, now you've lost almost $600,000 worth just in fees, right? So there's a really big impact on that. Another example here is from Vanguard, who are a well-known index fund management firm rather. And so here you can see here that, like, let's say you just had 100K invested and it earns 6% per year, and with no fees you'd end up with 430,000, right? So you can see here in this example, in this bar chart, with no costs, your initial 100,000, and then you've got this massive 330,000 that's come over the next 25 years because of the compounding. But if you just paid 2% a year in costs, well, now you lose $170,000 of that gain is gone. So this is the impact of fees, and this is why it's important to really pay attention to the fees that you're paying for whatever investment or whatever stock or bond or fund that you're in. So the next thing that we should look at is some of the recent news. So as I make this video on the 14th of June, just earlier on the 13th, we've seen Coinbase, who've come out with this Coinbase index fund, and now they're open for investment. So you can see here, now they are open for accredited investors, so you've got to have basically minimum 250K. So it's not just for the average mum and dad, unless they've got sizable assets. But the problem here is that they are weighting by market capitalization, and this is that cargo cult finance thing that I was referring to earlier. So now let's go to their actual website. So here's the Coinbase asset management website. It's open to the US accredited investors, and there's the first thing you should notice. Wow, 2% annual fee. What were we speaking about before? Well, hang on, that 2% fee over 25 years makes you lose out 170,000 of a 400, it just cuts out 40% of your value over 25 years worth of time. So you can already, at a first glance, say, well, hang on, something's a bit off here. Now, it could be understood that, okay, maybe there are certain structures that are difficult for you to invest in without having a fund that makes it easy for you. So as an example, in Australia, in your self-managed super fund or in your superannuation, and you needed an easy way to be able to do that, and you just wanted a fund, and maybe that would be better than the alternative. Okay, maybe there's an argument there. But nevertheless, I think, obviously, the way I think it'll evolve is over time, lots more competition will come out for funds, and that should hopefully lower the fee rate. But for now, just be wary that 2% is a very high fee. Now, here's the other problem. They're doing it as a basket of what they're calling digital assets. And so the current composition you can see here, it's got 61% Bitcoin, 27% Ethereum, 8% Bcash, and then 3% Litecoin. So you're starting to get a sense there that really they're sort of treating it like these are all different coins, but in reality, if you look at the way they sort of move together, now this is just one day's movement. Obviously, it's not the best example, but you can look here: Bitcoin, Ethereum, Bitcoin Cash, and Litecoin. And so you can sort of see that it's not like, even if you look at all of these crypto coins, it's not that they sort of move drastically differently to each other. Like, I'm sure if you looked at this, like similar for, say, the stock market, it might be a little bit more different. There might be some companies that went up that day and some that went down. But here, there's very few that went down today, right? So that almost helps give an example of why these assets are not really that uncorrelated. And from an investment point of view, if they're not that uncorrelated, then maybe there's not that much of a benefit to have from trying to diversify across the crypto tokens. The other problem is it's a bit more like cargo cult finance, in the sense that really it's not looking at it from a money point of view. Which one of these has the best chance to become the money of society? And so I would argue that the best chance out of all these is Bitcoin, and the others are just not even close. They are not even in the ballpark. So anyway, so that's what I think crypto funds are getting wrong. What could they... Where's the real value here? I think that what's one of the best things that financial planners and investment managers can do for their clients is really the behavioral coaching. And what I mean by that is, say, coaching you to help make better decisions, helping you make more rational, optimal decisions based on, say, a plan or an asset allocation or a tax strategy that you have set up in advance, rather than letting you fall victim to your own emotions or what's sort of happening in the news and the media around you. So it really, what a good financial planner will do for you is to help you do some of these things. It'll help you come up with an asset allocation. They'll help you consider, okay, what are your needs? What's your stage in life? What are you trying to do? What's a good tax strategy for you in terms of how you should buy or sell your assets or distribute the gains of those in such a way that it helps optimize your tax. They can help with helping you to asset rebalance. So let's say you start out with an allocation of 30%, say you went 60-40 stocks and bonds, right? Like a typical sort of asset allocation that someone might have. And then over time, there's a big, say there was a big bear market in stocks, bull market in stocks, and now it went to like 80-20. So now you got 80% stocks. Well, then that fee, that fund can help you automatically by rebalancing, or the financial planner might sort of look at your allocation and say, oh, hey, you need to rebalance. And they might help you periodically do that on a, whatever, monthly, 6-monthly, annual basis. So, and that will help you by sort of automatically helping you to buy low and sell high, which is sort of the number one rule of investing. So just as an example, let me just now flick back to screen share. So see this this little psychology of a market cycle. So I thought this was a really good graph, and one thing it explains well is that people can really get emotional during market cycles. So people can become over, optimistic and euphoric. And in the crypto world, this is probably what happened during, November and December last year. And then people start to, over time, that there might be a slight resurgence and then a bit of a dump or a crash. And now they start to panic and they start selling, and they might make bad decisions because they're not doing it against a certain plan that they had in mind in advance, that they had set up with a professional, and even the fact that even if you're really knowledgeable about finance, you might still need a coach, in the same way that, the top sports professionals, like even the number one tennis player and the number one golf player in the world, they will still have a coach, right? So it still makes sense that you might need someone to act as your guide. And so in the Bitcoin world, I think of that like someone who helps you hold through these sort of down cycles that happen. And they happen often, but what will happen over the long run is that generally, at least historically, every time it's come up much more than that. And the reason for that is to understand this whole case for sound money, and this case of why Bitcoin is the most sound thing out there. But in any case, what can happen is when people are not thinking from a sort of zoomed out rational point of view, they're just sort of caught in a certain moment, they're in panic mode, they might just sell, and then they're just reacting to what the market and what the news is saying. And paradoxically, you can see at this little section here, it's talking about how when it's really overpriced, that's the point of maximum risk. And then at this time that everyone is sort of hating Bitcoin or hating a certain asset, or maybe not even hating it, actually a better way to think about it might be more like apathetic about an asset. At that point, that's actually the best time for you to buy, because that's, giving you the best chance to, again, buy low, sell high, which is rule number one of investing, right? So that is how I would try to, suggest that funds could do better in advising their customers. So now let's distinguish here between someone who's, say, like a financial planner who actually does those roles that I was talking about, versus, say, like just a fund product, which is more like, it might in some ways passively help you achieve those things by doing the rebalancing for you, by doing, by helping you sort of stay the course. So I would suggest, as a concluding remark, I think crypto funds as they exist now, they're getting it wrong. The fees are too high, there's too many altcoins, but there's real value, there's real opportunities for them to give better value and provide better value for the investors, if these things get remedied. So I think we will see this space evolve over time, and it'll really mature. So that's the thoughts I had for you guys today. As always, if you liked that, please give me a like, comment, share the video, and subscribe to the channel. And otherwise, find me on Twitter @Stefan Livera. Thanks, guys. See you in the next one.